Great. Another minute or so, but Frank and I are really excited to talk to everyone today. We're going to be going through our presentation here around finance and tips for your next fundraise as it relates to your finance function. If you have any questions, there's a little chat box, Q&A down at the bottom of Zoom here. Feel free to write us a note. You can also email matt@visible.vc with any questions, or use Twitter, #VisibleWebinars. We'll collect those questions and respond to them at the end of the webinar. If anyone has a question they forgot or want more clarity, feel free to email Matt again, and we'll make sure to respond if we can. So we're gonna try to keep today to a tight 30 minutes or so, and then from there, answer some Q&A for 10 or 15 minutes. And I'll also note that this whole thing's being recorded, so we'll make sure to send it out to the entire email list once it's done, and so you have it for after the webinar as well. So just to get started, would love to introduce Frank. Frank started his career in the Big Four and then moved into operational roles at Motorola and then Match.com, and then started a service called Punch Financial, really a CFO service, really geared towards startups and Southern California. Punch then recently became part of GCG, which is a firm helping over 80 different startups in the Bay Area with their finance function. They also work with venture funds as well, doing something very similar. And Frank also calls Bay Area home now and is also a mentor at 500 Startups. Anything I forget there, Frank?
Nope. That was a good job. Thanks.
Awesome. I've known Frank now for a while. Frank uses Visible with a lot of his clients and his customers, and been a great partner to us, and we're really excited to jump in today. For users that don't know me, my name is Mike Priest. I'm the founder of Visible. I'm going to be hosting this webinar. Really think of it as like a fireside chat. We did this last month with Elizabeth Meehan on the investment side of things, and it went really well and had a lot of great feedback. So please send that our way. And we'll do the same thing today, just more on the operational side of things. So if you have any questions, again, Zoom chat, there's a Q&A in the bottom, #VisibleWebinars on Twitter, and matt@visible.vc if you just want to email it. So 3 different ways to contact us with any questions. But let's get started. So, we're going to cover your financials and really telling the story of your financials, how to think about forecasting and budgeting, managing cash as it relates to your fundraising, how to best work with accounting and finance leaders, especially if you're a CEO or founder, maybe with not a ton of experience in that field. The kind of important relationships between contractors and employees, and then just talk about software when it comes to accounting, cap tables, things like that. But let's just get started and dive right in, Frank. Let's talk about financial statements and really the narrative of financial statements and as it relates to the fundraise. And maybe just to start, we'd love to hear, like, what story should your financials be telling when you're going out for a fundraise, and maybe break it down, call it pre-seed, seed, and maybe Series A, kind of earlier stage companies. Like, how should they think about financials and as it pertains to the fundraise?
Good question, Mike. What I would say is it's pretty easy to reverse engineer it, right? What we see on the mistake side is people set up their chart of accounts. QuickBooks gives you a standard chart of accounts. It's too generic. They bundle too much of the activity into bigger groups. And so the financial statements literally should narrate like you would if you were pitching your fundraising deck, right? And so what we say is start building your revenue streams into the financials. So if it's different channels for revenue that you're selling, and or different revenue models, then have it dictate in the cap table. So a good example, I'll use Honey a lot because they're such a good success story, but they started introducing different products and different revenue streams with different partnerships with some of the different the affiliate networks, right? So we started tracking where the revenue was coming, which affiliate network, in addition also geographically. So we started breaking out the revenue internationally in Australia, so that one, you can always consolidate and do sub accounts in your GL, but have the revenue, especially because that's the focus of your fundraise, start early, right? Start early, start building it in so that you can dictate what you're saying in your deck is going to be reflected when they look at the financial statements. And so that would be one thing I would say. So whether it's pre-seed, seed, I always say start early. Good practices, build it in early so that as you grow, it becomes second nature to everyone involved, and it's not having to go back. Same case in point with Honey. When we started with Honey, the first thing the venture capitalist said to us when we were raising the next round is, what happened to all the data prior to January 2015? And we said, we don't know. That's when Punch started with us, right? So we didn't go back. And so that, again, it looks weird when you're missing, data. So I would say the earlier you can, putting the same type of KPIs that you're looking to do on fundraising, build it into your financial statements. The narrative from your fundraising deck should flow through straight to your financial statements and in your visible reports that you're sending out, right?
Yeah, I mean, I think that's so key, right? Is you're kind of telling the story through your deck, and you have these metrics and KPIs, and then a lot of times what you'll see is like just a major disconnect. Like you get into the diligence, and then they're like, yeah, some of your financials, and they're like, whoa, this is way different than what I was expecting based on the deck. And so I think building in some of that practice early is really helpful. What about you touched on revenue? What about your expenses? How should companies think about categorizing their expenses and in telling the story of those?
Equally as so, especially early on, Mike. Good point. On the expense side, when you're pre-revenue, right? Again, good fences make good neighbors. Same thing here. I would say, travel, the areas that in VCs and investors like to look at as payroll, customer acquisition costs, and travel, right? And travel and entertainment, because a lot of the companies are overspending in that. So we really starting to tell the narrative. So if your sales team's flying to meet with customers, then that travel we break out separately for sales, right? And so we break it out by function so that the narrative also shows that, hey, you're not just flying to go to a conference, right? It's very focused in what you're trying to accomplish, whether it's B2B sales or whatnot. So those are the areas, again, not to steal some thunder later on, but also R&D tax credit. So knowing how to track payroll for your engineers and your, the people, product team that are applying for R&D tax credit, we like to break those out separately in the GL. You're, again, back to the Honey story.
Yeah.
Their customer acquisition costs, blended was X, but we had, we tracked by channel and by region also on the expense side, right? You could always can roll up and consolidate, Mike, but the key is putting in the infrastructure early and break and having it go all the way through. So those are the big three that I like to focus on. And now travel and, meals and entertainment, big category with the tax changes, internal are still, if it's your own team, they're 100% deductible. The outside used to be 50% deductible. That's gone. But we still track that, right?
Yeah.
And so I also coach a lot of the startups to, if your team's going to take out, one or two clients, then I also ask them to break out the checks, right? So if my one check is all the visible team, and then, there's one check with the clients, then the team is deductible, right? Tax wise, and the client is not.
Interesting.
Does that make sense?
Yeah, that makes total sense. And I think the one thing, and maybe we can come back to this, but just to touch on CAC and customer acquisition costs, because I think that's so important as you're making assumptions about your business and how much it actually costs you to acquire a customer and how much they're worth in the long run. Is, we see quite a bit. People have a very simplistic view of CAC when it's usually pretty complex, like what salaries are you attributing to CAC and all these other activities you're doing. And as bringing it back to fundraising, a lot of the time, one of the questions you'll get is what's the use of proceeds, right? And if you can paint a picture with CAC of and split it out by channel, saying hey, this channel's performing really well, our CAC is low, we're gonna go blow this out with fundraising, that tells a lot better story than having a very simplistic view of what CAC is. And I think you nailed it with kind of that breakdown of how you should be thinking about CAC. I want to come back to that. I wrote a couple notes down.
Yeah, but it leads into probably the next, right? Which is
Yeah,
COG
margin.
and margin is one of the
Yeah.
big mistakes startups make early on. And I always say this, but the prophet on CNBC, that Marcus Lemonis, the one thing that he does really, really well that I think every startup founder should do is truly look at what your cost of goods sold is. And it's really simple. The GAAP accounting rules vary, but I always say, hey, if this cost or this expense didn't exist, you couldn't deliver your product to your customer, and therefore you couldn't collect your revenue. So, AWS, all the things, like you said, people that are attributed to keeping the product up and running and delivered are required to be COGS that sold. And so a lot of the feedback and laugh we get from some of the VCs is that, everyone's margins are 85, 90%. That's typically not the case when you start going and applying GAAP. It's, they pick that apart. So the better you dictate this early, the more impressive it's going to be, and you're going to help yourself long term.
I know it's going to completely range by business, right? E-commerce will look much different than SaaS, than maybe a consumer app. But like, what types of benchmarks are you seeing at GCG for gross margin across some of your different types of businesses you guys support?
Well, this is the hot topic that I like to tweet about. So I always tell all the founders I work with, your margins aren't 55 to 60%. Good luck staying profitable, which leads into the whole gig economy, Airbnb, Uber, 20%. It's hard, very hard. You have to scale that thing really mega big, and still then you can't, look at the profitability of those companies. And so even if you look back to, we watch 1 or 2 episodes of Marcus Lemonis on profit, same thing, right? No good business doesn't start with a margin at least of, 55, 60%, regardless of what it is. Now a SaaS model, once it's built, you can sell it out, but you're still, and of all people, you still have to iterate with new features, new products, trying to drive additional revenue. So, I always try to get, if you can get 100%, get it to 60, 75% of gross margin, great. Like, that's a healthy company. And then also, I say, also will cover some of the mistakes you're going to make as a founder. They're going to happen. So if you have that healthier margin, then it could help smooth out some of the hiccups that as you plateau at Match was a good example. We would grow and then plateau, hit a ceiling. And then we'd have to figure out how to go get new customers, how to, deliver the product at a cheaper expense. AWS grows out of control fast. Start strategizing with your tech team to, do layers of data, right? And drive your AWS costs down. So there's a lot of things that come into it, but it takes a full management team strategy on COGS. Is what I would.
What about this is going to be a super technical question. I'm going to actually have 2 separate questions. So one, let's start with early stage companies. I think a lot of our audience, fit in that probably 0 to call it $3 or $4 million a year revenue business. How much does this matter with fundraising? Do investors care about margin? I know it's such a hot topic now with things like WeWork and Uber and all these businesses, but do they care about it, or are they just does this business actually, is there demand here for this business and we'll figure out margin later? Or is it starting to be the other way around where it's let's get margin dialed in and then we can figure out how to scale the business?
Well, it is a little bit of a chicken and an egg, just like you described it. But the reality, I always say, is what do you want to do, right? So there's two schools of thought big time on this. And so, and I also think, the philosophy, and now being in the Bay Area, of we'll throw a lot of money, grow fast, and then figure out how to ratchet in profit. I think the pendulum finally has swung, and that is no longer going to be the way, because you're starting to see the real struggle that Airbnb, all these guys are having to try to get to path to profitability. You and I talked about Uber, Dara was just on CNBC and he's saying the path to profitability is 2021. Well, Wall Street's not going to wait 2 years. The stock dropped 12% just on that one interview, right? So, the days of, hey, figure it out later, are kind of, you're going to pay the piper. You're just kicking the can down the road. So I would say, build it in now, and yeah, you might have to discount. And a lot of SaaS companies, I say, figure out what your pricing needs to be with healthy margins. And then if you need to discount it early on to sell it because brand awareness is not there, they don't know who the hell you are, then yeah, but a lot of the SaaS companies like Kangaroo Time that we work with, we know what the pricing at once you get to scale and there's enough features there and people really want to pay and they're addicted to your product, what would be that pricing, right? And so we use that as list pricing, and then we discount it if the sales guys need to to wheel and deal to get traction, right? So we understand that traction's key and market fit is key, but it has to, when you're at full scale, what will be your margin? And they want to know what their thought pattern is behind it. So
smart. Yeah.
That's
okay.
Yep.
Yeah, I love that. So just playing that back is, start with the end in mind of what do we believe our price point should be for a healthy margin. But early days, as you're fighting for customers and getting people to take a flyer on your business, feel free to discount it, knowing that you have some end state in mind when it comes to price.
And a lot of companies, a lot of startups don't do that, Mike. On revenue, they'll book what the contract says and what they collected. And I always say, it's also beneficial to show to the customer that they're getting a reduction in price, right? So say $1,000,
interesting,
we're giving it to you, and then record the discount. And any smart investor is going to realize that you're going to have to heavily discount to get traction, but it shows that you've put in all the thought, right? And so those are the smart start founders that there's a path to profitability already built into their strategy. It's not, just grow and then we'll figure it out later, right? Like that kick the can down the road, I think is a very dangerous strategy.
Yeah, I love that. That's going to be in our write-up, I think, for this post-webinar. This is kind of boring, at least personally, I think it's boring, but it's important. Let's just talk about GAAP and non-GAAP. Why should an early stage company care? Does it matter? Does this affect my ability to fundraise? Like maybe spend just a couple minutes here talking about GAAP versus non-GAAP financials.
Yeah, this is my soapbox, and on Twitter, or anyone that follows me, I think getting you hire the best attorneys out there, you hire the best engineers, and then when you go to hire accountants, you find a bookkeeper that off of Craigslist that doesn't know GAAP. It's bad, right? It's just bad form, because investors think about it. The investors are like, I'm giving you my money, and then you're handing it off to someone that isn't best in class, right? And so I would say, I wish I could have recorded the M&A panel at Pillsbury a couple of years ago with the founder of AdMob. He would be, what he did when he started AdMob and what he now says that he does with his new startups is, do GAAP from day one, hire understand it, because during the acquisition from Google, they had to go back and restate all their revenue and follow GAAP before Google would acquire them. And it was taking way too long, and Google got cold feet and almost pulled the deal.
Yeah.
He said, I'll never do this again. I will follow process early, because revenue recognition is key, right? If you're doing cash flow basis on revenue recognition, that's not what, especially if it's a public company that's buying you, they can't swallow that company, right? Because they have to it has to be GAAP. They have to be GAAP. So, so start early. Like it's worth it. Find the right partner. And then it becomes second nature, and it's easier than having to go back and clean up a mess of 4 years and not having the data and not knowing who did it back then. It's a lot more difficult than it is. Than it is than do. And here's where I differ a lot, with the VCs, is they're like, oh, don't worry about it. We'll figure it out later when you're up against the sale. Again, the VCs just want to see early traction and get that quick growth. But I say, mind your shop early, and the founders should really focus on this, because it can really limit your ability to exit later on, and it eliminates some of your acquisition targets, because if it's not something that they can make accretive to their own financial statements, they're going to say it's too big of a mess. It's not worth it. Right.
Totally. Yeah. I mean, I think the biggest thing you can do, whether you're fundraising for your business or M&A, right, is create a competitive process. And with a competitive process, right, you want things like time, urgency matter. And as you're going through that diligence phase, any slight red flag could take someone out of that competitive process, and you're left with less than ideal options or no options at all. And so I think that's really key to think about this as well, is just like, we have the right things in place. Give the partner, the acquirer, the financier less reasons to say no as you're running that process.
Yep.
Along the financing route, I want to talk about budgets, forecasts, projections. I think in the Twitter ecosystem and VC Twitter, you get a lot of different takes on this. And when it comes to that quintessential, like, hey, please, send me your next 5 years of projections, right? And it's so hard to let alone know what I'm going to do in 6 months from now. So, like, what is your take on forecast? Like, first, maybe break down for the audience, like, the difference between a budget, a forecast, and projection, and then from there, like, what's your take on how I should think about modeling these, right? Like, knowing I'm not going to predict what's going to happen 5 years from now, but like, what exercise is the VC putting me through in that scenario?
So projections, forecasts, I always, my philosophy is, going out more than 3 years is really ridiculous, because, nothing, and I've been with, a lot of fast growing companies, your projections it never goes the way you think it's going to go, because there's things that happen, right? So,
yeah.
So my thing is, at the end of the day, the VCs or the investors are wanting to see that you, think, how big could this be? Is this a $150 million business, or, kind of the rule of thumb benchmark to go public, or is this only a 20 million lifestyle business, right? So that's what they're really trying to see. And so that, I always say, it's really good. And we work with our clients in the exercise of strategy session and breaking it down, and building this, because a good forecast and projection model that you'll use for your deck is also the chart of accounts that we talked about in slide 1, right? So if you build the forecast and model at the granularity that you want to track it at, then there's no disconnects, right? And you hit the nail on the head, Mike. A lot of the VCs are looking for, well, you said in your deck this, and now your model doesn't even show that revenue model, right? Or revenue stream. So which one is it? So there's a lot of disconnect. So for the Kate, I always say, build the forecasts and projections to tie to your fundraising. Don't, once you set it for that fundraising route, don't keep tweaking it, because you'll go crazy if you did it every time you met with a different investor. Because they'll pick apart something, and then if you tweak that, you'll be changing it on the fly.
Yeah.
So I say, build your forecast and your projections, and again, make them reasonable, so that if you have to defend them. And so they're really looking at kind of, did you take a holistic approach, and do you really know what it's going to cost to run your business? So, the joke with most investors are, we are going to take your revenue projections and cut them in half, and we're going to take your expenses and double them. And that's most likely what's going to really happen, because most companies think they're going to be profitable and revenue is going to be great. So I would say, really spend time on this, and that's your most guarded asset. So a lot of the things I say, and here's probably one of the biggest tips I'll say, is don't send that out to investors or prospective investors, because I get these models and projections all the time from venture clients. And it's strategic data. It's, where you're going to go for your customer acquisition, how you're going to grow, how fast you're going to grow. And so I always say, give that snapshot, and then happily go into the deep dive with the investors that are serious, but don't send it over, do a screen share like we're doing on Zoom right now.
So you're saying kind of use that as kind of like a quid pro quo, right? In that process, like, not just hand it over, but you want to dive in with an investor and slowly release that information over
Yep.
time.
Yep. And I say that's great and that's good. Now, from that, I always say, the second, what we do with our clients is the second phase of that is, okay, now realistically, the forecast and projections, if everything goes perfectly, right? Right.
Yeah.
Hockey stick, perfect customer acquisition. Right. So I say, okay, now that's great. And that's in an ideal situation, but a budget, I think, is more, the founder's responsibility to keep the company afloat, to get to that next milestone, to go raise the next round. And so how do you do that? And this, I feel, is a deficiency with a lot of founders, because they're running their checkbook like they did when they're in college, right? As long as there's money in the checkbook, I'm good. And that's not the case. You really need to make sure you have enough runway. So as your product's being developed, and your revenue is starting to grow, you need to have enough runway and scheduled time to go do that next raise. And budgets are the best way to do it. And I really implore people to use budget versus actuals out of QuickBooks or Xero or whatever, to see where you are vis-a-vis. Because by the time they realize that they overspent 1 month, Mike, it's 2 months later, right? They do stop the burn. And so you need to do it quickly and realize that you're tracking over because XYZ, Susie's buying too many Post-its. I don't know, right? Like, you want to stop it early. And if you wait 2 or 3 months to look at that, then you've had 2 or 3 months of burn. And now your runway is just shortened by, 2 or 3 months, and good luck, right?
Yeah. I think that's spot on. The other point I wanted to add before moving on is, I think it's also just a way for investors to think about how the founders think about their business, and I guess, like, do they understand what it takes to scale or grow their business? So, in a forecast, if you're paying someone $100,000 a year and a budget $100,000 a year, right? That's not $100,000 a year for you as a company, right? You have payroll expenses, variable costs when it comes to things like healthcare, desk space, computer equipment. And so I think what we see that a lot is people make an assumption of, if someone's $100,000 a year salary, that's probably closer to like $150,000 a year, right? For your business. So I think that's a key one that I saw recently floating around Twitter. Is it's also just like a litmus test. Like, do they understand the different levers of where costs are in the business as well?
I always say, Mike, they use the budget as a body check, like in hockey, right?
Yeah.
Check you to see, I'm going to do a deep dive to see, do you truly know what the cost of insurance is going to be, right? And so, like you said, we see that one payroll, and then adding 25 to 30% for employer portion of payroll taxes and benefits. That's a big missing gap. Insurance, making sure you're adequately covered, and risk reduction, expenses that as you scale, you're going to see. And part of that too, Mike, is what culture do you want to build? So start thinking early on, to be competitive in a lot of the high tech areas, you got to give 100% medical coverage, right?
Yep.
The company to be competitive for engineers. And so if you're not absorbing in your model 100% of employee benefits to compete with the big, FANG companies that you're competing with here, then you're going to not win those people, right? When they can go get those benefits there. So you're spot on with that.
Awesome. Let's talk about cash and cash management. So, we touched on revenue and discounting revenue and how that you can build a story, but at the end of the day, cash is like the lifeblood of a company. So if you're not getting paid on your receivables, you're going to go out of business. So like, what are best practices for managing cash, receivables? What about like something as tactical as banking? Like, there's a ton of new upstarts out there, things like Mercury Bank and Novo, and then you have your tried and true like Silicon Valley Bank. Like, what is your take on, I guess, the type of bank you want to use for your company, and then like best practices for managing receivables?
Good questions. All really good questions that I get asked every day, right? Cash is king. At the end of the day, cash is king, right? And so that's why everyone asks what your burn is, because cash in, cash out, and managing that. And that goes back to the budgeting, right? So if you know that you're sticking to your budget on path, what I always say is, hey, take your investments, whatever the investment is that you don't need to do, you don't need to operate, and put that to work to your benefit, right?
Yep.
So go get, and you mentioned Silicon Valley Bank. Now there's a lot more competition, but SVB used to use a sweep account that was a money market account, and the return on it was not that great. And so now you're seeing a lot more competition, even with, like, say, Fidelity and Mercury Bank, like you mentioned, where I'm talking to their product team on this specific issue, right? It's called treasury function, right? Big corporations have a treasury function. That's Apple's probably the best example, right? How are they putting their cash to work? Because they have a ton of it, right? And that's investing. And so I think the same good practices need to be started by the startups. Is one, you don't want all your cash sitting in your checking account. God forbid, for whatever reasons, there's a lot of social engineering hacks that are going on. So you want it in a separate account. And ideally, I like to put it in a separate bank. So if you're operating out of your operating account for payroll and, accounts payable and everything is using Chase or Silicon Valley Bank or whoever, then I always like to put my treasury function in a different bank, right? So that it's truly walled off and no one can get to it, and no one knows that account information but your key people. And you have to make sure that, as payroll is running, you sweep in, and you can set up automatic sweeps. So the technology's there, that you need $250,000 a month. So, you trigger that sweep from one money management account into your operating account. So I really feel like setting that up properly early on is important. Two, AR, companies always get, especially startups, get uncomfortable having to go collect the cash, but because of customers, but the squeaky wheel gets the oil, right? And I tell the founders, that you are limiting what you're paying out based on cash flow. And so, people are doing the same thing to you, right? They're holding off. If you start barking about, hey, where's my money? And it could be done in a polite way, and you can use the automation in QuickBooks, but the squeaky wheel gets the oil and you get paid, right? And when they know their accounts payable, your client's accounts payable team knows that you're going to, within 45 days be asking, they're not going to let it slip, right? They're going to get paid. So ideally, everyone says this, right? You want to shorten your AR cycle and you want to increase your AP cycle. So, but set that up early. And on the AP side, I see this mistake all the time because the founders get busy and then, they, get an invoice, they pay it right away through bill.com, right? Well, you're setting up that for failure as you scale, because now that vendor expects to get paid immediately upon that invoice. So set up a cycle time, set it up early. We do it once every other week. So, bi-weekly, anything that's in on by Wednesday will get approved and paid by Friday. And you communicate that with your vendors and your contractors, and they all know that that's the cycle, right? And then you can kind of ratchet it back, but it's really important to set those policies early, right?
Yeah, I think that's key. I wanted to jump in on the receivable side, particularly from the startup hat. So early on, we had customers signing up for Visible and some larger deals where they were paying us through like check and just weren't paying. And I had to learn like the hard way that just get that conversation out of the way early. And like you said, you can be nice about it. But the one thing I like to do is just like, hey, like we have an agreement, but two, it's like, we make all kinds of decisions based on you as, as a customer, whether it's hiring new support reps, building features for the product, and just a lot of things based on our agreement. So we'd love to have you pay that. Like, that's the way I always like to phrase it. And it works, 100% of the time. But I know that at least the first time that I encountered that, it was super uncomfortable because you're taking one of your customers and you're like, hey, pay me. But at the end of the day, if they don't pay you, you don't have a business or product.
Your point, Mike, I think also setting your policies early, like to say, now QuickBooks allows you to automatic ACH, right? So, but you get approval and signature from the customer, and don't be apologetic. This is our policy. Get it set up early, and when they know that that's your process and you're going to automatically ACH the standard flat amount every month, then no one balks at it. But right.
Yep.
So it's important to get that, because getting paid is critical to keeping the business alive.
Yeah, cool. All right, we got some good questions rolling in. So I want to see if we can wrap up these last 5 and 10 minutes, which would be tricky. So let's talk contractors versus employees maybe for a minute. I think you mentioned in the past, like plumber tests, like what are the risks or tax issues that can arise from this? But like, what are your obligations as a company, as you think about contractor versus employee?
I think this is super critical, and a lot of folks, and I get it. I've been in your seat as a founder. You have to early on balance between contractor and employee, but there's a lot of litmus tests. I always tell people, and the states are getting more aggressive because the gig economy has caused payroll taxes to drop dramatically, and so California and Washington State are two that are very, very aggressive about this. And so I always say the plumber test is, if you call the plumber to come fix your sink, they show up with their own tools. They tell you when they're going to show up. They give you a window and then never show up in that window, right?
Yeah.
And then they get it done, get it unclogged. They give you an invoice and say pay it on the spot or send a check in, right? That's truly a contractor. You don't tell them when to show up. They tell you. They bring their own tools. They're not using assets from the company.
Mm-hmm.
And then it's an invoice situation. So the things that have got people in trouble is, one, a contractor then files for unemployment. That's the kiss of death. It opens an audit. And here's the risk that I always tell the founders. If the Department of Labor's of California, the EDD and Washington, I'm using those as examples.
Yeah.
But if they find that that person should have been classified as an employee and not a contractor, then the company is liable for both pieces of the taxes, right? So they should have withheld from the contractor and the employer portion. And here's the scary part. California, if the company goes bankrupt because they can't afford it, that liability does not go away. It follows the founders, right? And so
that's scary.
It is scary because it's your responsibility to do this right. So I always say, manage this as well as you can. If you're going to use a contractor, make sure they're sending you invoices. Hopefully it's not the same amount each time, because that's what happens. And they say that's an employee, that's not a contractor. And always manage to contractors on a contract. So meaning it's 3 months, we'll renew it. And so that they know when things are going to end, because the things that I've seen go wrong, and we need to speed this up, but is, oh, I don't need you anymore. I tell you not to show up next week. Now, I personally was managing my finances as a contractor / regular payroll. I now go file for unemployment, and then that opens a whole Pandora's box. So this is a very big topic that we could talk a lot about on it, but I'm seeing more and more companies get dinged on this. So it's a very real issue.
Very real. I'll touch on investor updates real quick. Bias, we do this for a living at Visible, but and especially as it relates to Fundraise. So one is, and I see this more common, especially as you are going out for your Series A or later, or even in diligence, I've seen this come up where investors want to see the last 12 months of investor updates. Like, hey, can you share what you've been sharing with your investors? And so I think that's key. Just like, setting up your chart of accounts is building that rigor in early and making sure you have a cadence. Because what you don't want to do in that process, if you're going out to raise your Series A, is, you have like 3 months of investor updates, then none. And then you go out to raise again, and you have like 2, right? You have the huge gap, and it raises a lot of flags. And so I think cadence is really important, whether it's good or bad news. I don't think it matters. As long as the investor knows, like, hey, I'm going to be engaged with this portfolio company or potential investment. And then they're not going to go dark on me the second I write them a check. The last thing I'll mention is just being consistent, not only with the cadence, but the content. So if I'm tracking apples in February, I should be tracking apples in March. I don't want to be changing my different key metrics I'm sharing with investors, because again, it just shows that you have, one, lack of focus, And two, you're probably just trying to juice it to make it look better than it is because you're saying, oh, we grew 100% this month with active users. And then, something else the following month, like we had 2 new customers and that's 100% growth. So I just say make sure to keep it consistent with both content and the cadence. But also they're a tool to use in future fundraisers and acquisitions as well. Let's touch on this. Maybe we could actually end with the relationship here with founders in finance. Let's talk insurance. This is the bane of my existence. I had my insurance canceled on me because I forgot to pay it when I was on my honeymoon. Like what stage does insurance start to matter for a startup? What kind of coverage should they consider? Maybe just at a minimum level. What does this cost?
Yeah, I think, again, if you see my Twitter feed, this is my soapbox. I think most startups are underinsured. I get you're trying to manage whatever investment you have and cash you have, but think about it, you have to protect your family, right?
Yep.
Mike, and this is, so I see this, one, the investors are going to look to see that, are you protecting them too? So, everyone gets, general liability, but that's great, but you need to look at tech liability, right? And social engineering is separate from that. So if someone hacks, by tricking one of your employees to give them their password, that's not covered by the regular technical liability. EPL, employee practices liability. So whether you're using a PEO like TriNet or not, I always say it's worth getting EPL, employee practices liability. I've had numerous startups get sued by one employee and that burn up all their cash and they go out of business. So EPL will step in there. Directors and officers insurance is not that expensive. And there's certain brokers out there that will give you a hybrid, at least cover a lot of these areas, even if they're lower caps, but you should do, I say, the whole suite. So directors and officers, so that you can't personally get sued. And they can't come over your personal assets. And especially when investors get on your board, they demand that directors and officers liability insurance because they don't want to get sued as a director if you're sitting on your board. So those are the keys insurances. There's a couple more that, if you want to be extra protected, but I think it's really important to have at least the 5 that I just mentioned.
Yeah, great. Let me, Zoom is in the way here. Okay. Real quick, we talked about kind of capital on the venture side, but I think you're starting to see a lot of unique and differentiated offerings when it comes to other ways you can finance your business. Clearbank, Stripe has their own offering on the kind of just pure on cash side, lighter capital again on revenue or recurring revenue. You have traditional lines of credit out there. You have venture debt as well. Maybe let's not put that one to the side, but let's just talk about like, how should companies think about these other options available to them? And like, are they a good thing or bad thing as a signal when they're going out to fundraise?
Yeah, I'm very vocal on this. I think what you're starting to see is, the longer you delay going out to getting institutional investment, Mike, the more of the equity you're going to keep. Yeah, but that's a lot more difficult, right? It's a lot more heavy lifting. So people see, hey, I'm going to go, read TechCrunch. I'm going to go raise money from one of the blue chip funds, and they're going to give me a big check, and my life's going to be a lot easier. But in that approach, you're giving away a lot of the equity, right, and a lot of the control. So I think the more you can get creative in your financing early on, the more you're going to keep in the later stage. Then you have leverage when you go to negotiate that institutional investment. Even with the big names, right? When you have revenue. Like I'll use Honey again, or Loot Crate, or a couple others that were really big, so that the power of, the negotiating power landed with the fund, with the startup. This goes back to banking too. Build relationships early on with banks and not the commercial banks that everyone knows. There's a whole slew of banks that people don't know because they're not marketing to the general public, like a Silicon Valley Bank or a Bridge Bank or Mercury or a bunch of these others that are showing up as ways to help you extend that, getting debt financing or line of credit. And what you're seeing with the merchant processors like Stripe and everything else is based on your historical processing on the e-commerce side, or if that is, they'll give you a line because they know that month over month for the last 2 years, you've been doing an average of 25 or 50K in revenue. So they'll give you a line of credit to manage your ARAP situation that we talked about earlier. So
Yeah.
there's a lot of ways, but you got to start early on building these relationships, because you can't, I always joke, people come down to the valley and think they're going to go down Sand Hill Road, like in Oprah is going to be like, hey, you get a check and you get a check. No, you got to build relationships, and banking's key, right? People don't think about that. And so when you need that line of credit, and there's fast pay, and there's a bunch of other people that are really getting industry specific and smart. And they're not so as aggressive as factoring is. So there's a lot of things you can do here. And this is where having the right finance CFO advisor can really, they have a lot of these relationships. They can make the introductions. They can help you navigate this area.
Awesome. So let's end. We have a couple of great questions coming in. Let's end maybe with the relationship a founder should have with their finance lead, whether that's maybe internal at your company or someone external, like, Frank at GCG. Like, what should a founder expect to get out of that relationship? How should they get the most out of that relationship? What should that just look like in general? And so everyone's successful, right? In that, but like, that's one thing I probably struggle with myself, is just like, how should you think about your relationship with, who's handling your finance function, whether internally or externally?
Really good question. I think it's the difference between a really successful startup and a non-successful startup. The relationship, anyone can close the books, right? And timeliness and strong internal controls are all kind of, I feel like, the baseline bench that you need.
Yep.
You guys are busy. I always tell my founders, focus on product and sales. That's your only focus. And then surround yourself by the best of the best in every other area. And as outside CFO or at GCG or working with clients, my job is to pick your head up and say, here's when you need to focus, right? Sales tax, or let's talk about when's the runway going to end, and when do we need to start going out and fundraise, and how do we grease the wheel? And a lot of times, it's easy for me to brag about Visible to venture guys that we work with than you are, right? It makes you douchey. It makes us kind of, cool, because we're giving insight into companies because we know what your books look like. So I think it's a really important, if you try to do the Spirit Airlines of, cheap bookkeeping, great, but you're losing on all the strategy piece that you don't have experience to, and exposure to. So I say you get what you pay for, and venture guys, investors know, and they can tell the difference, right? They see, I've been told this all the time, your financial statements are so more sophisticated. So therefore I know I'm dealing with someone more sophisticated. I can't strong arm them in the negotiations, because I know that they know, because the financial statements tell us that, right? So I think it's very critical in the whole process.
Awesome. All right, so we got a bunch of questions. So we'll Kirsten, I saw your question come in through Zoom. We're going to respond to that one through email. I think it's a great question and tactical, so we'll make sure Frank gives you a chance, or we'll make sure Frank responds to that one. Let's talk about, so the three things here that I think are pretty good, and we'll wrap up, respecting, I think, your time and everyone else's. So how much emphasis should I put on annual contracts when it comes to collecting AR and managing cash? So I think kind of the gist is like, should I put a lot of emphasis on getting that payment up front all annually and really focus on that, or should I maybe deprioritize that for my company?
I think it's smart creative financing. We did it at Match in the early days, and it's a way to delay having to go fundraise, but incentivize your customers. So we did that at Kangaroo Time, right? So they're selling to daycare centers. And so we said, if you pay the annual contract up front, we'll give you a 10% discount.
Yep.
That's the cheapest money you're going to get. And then you control the float. So that's huge from a cash operations perspective. The second part is, even when you go fundraise, having a locked up contract for a year versus month to month as you pay as you go. There's more value in from an investor perspective that and it's showing product market fit, right? If I'm willing to commit to a year and pay you up front, then I really like the product. and I really think, I'm not going anywhere. So there's a lot of wins from doing it. So I think I would build it in, but incentivize them to do it. Dating's the best example. If you pay for 3 months, 3 month subscription, you get a 20% discount. If you pay for an annual subscription, especially in a SaaS model, the cost of building the product's already there. So it's really becoming a financing strategy, but cash is king again. So getting in the door up front saves a whole lot of headaches of trying to collect it monthly.
I think that's smart. So would that strategy work with like, I have revenue, then I have that discount. Is that a discount then in my cost of goods sold? Yeah, kind of what we talked about earlier.
Well, so we would bucketize that revenue. So the monthly pay-to-pay subscription is a separate SKU in the merchant processor, and then in the annual. So we have buckets, and that's back to the initial screen of that's how it ties into the revenue on the financial statements. So we would throw prepaid 1 year subscription in a different bucket and amortize, because you have to amortize that over the full 12 months.
Another great question. So we're pre-revenue. Should I avoid sharing financials entirely with potential investors and focus solely on my total addressable market, team, product, or should I open up some of that? So how should I think about my financials if I'm a pre-revenue startup?
No, again, building a solid, honest relationship, like good or bad, they want to know burn. So they want to see how well you're managing your burn. And so what I would say is set the frequency that you want early on. If you start monthly and then try to scale back, people are going to balk. So I always say start quarterly, and then if you need to ratchet it back to monthly, but yeah, no, it's about getting the regular, back to your product visible, right? Getting a regular, consistent relationship, showing good or bad. I say go ugly early all the time, because investors know if they're smart investors, things don't go right. And so you want to be able to go to them and say, here's what's going wrong. Here's the 5 things we're working on. And by the way, can you help us fix any of them, right? Investors help.
Awesome. Well, I think that's going to wrap it up for us today. If we didn't get to your question, we're going to write you back through email and personally respond. I want to thank Frank for joining us. I think this has been a great conversation. This thing's been completely recorded, so we're going to upload this, write a follow-up blog post with some of the key takeaways, and share it out with everyone that attended or registered. So Frank, thanks for your time. This has been great. And everyone else, thanks for joining, and we'll talk to you soon.
Thanks, Matt. Mike, sorry. I was probably confused.
Bye.